All right, please pay attention, all of you, because we're getting into a few concepts. This will basically revise all your previous chapters, not all the previous chapters, but the T account, the way T accounts work. And it will also teach you about the horizontal method of income statement, the horizontal. The horizontal method won't be tested in exam, but you need to be aware of that for the purpose of double entry, for the transfers. You'll be asked about the transfers. For example, at the end of the year, you will need to transfer rent expense to income statement. How will you do that transaction? You'll have to debit your income statement, credit the rent account. Why is that? Right? Questions like these. So we'll do that until like half of the class. And for the other half, if we have time, we will start chapter 9, which is about balance sheet. This one's about income statement. Okay. I'll take you to the board and we'll continue from here. So as you guys know, we have mainly, we can say broadly 6 categories of accounts, right? Not necessarily categories, but I mean, these are the 6 main things. I would actually add 2, 3, 4 more to it. I'll make it 10. There are 10 main types of accounts you will see in your whole syllabus, right? One list is, we have assets. Wait, change the brush size. With assets, right? We have expenses. I know we obviously have liabilities and capital right on top of your mind. You have that, but we'll still categorize them in a certain way. You will see why. Assets, expenses, drawings. And by the way, assets is a whole category. You will see plenty of them. Your trade receivables is a type of asset, right? Your customers' accounts are your asset accounts. Your machinery, any non-current assets, machinery, vehicle, anything that the business owns, right? And what others owe to the business, things like trade receivable. Expenses are the, you take certain services from people and you have to pay for them. Like you have to pay wages to your employees, right? You have to pay rent to live in a place, or rent out a premises. So we have assets, expenses, drawings, purchases, right? We've gone into these before, but now we're just getting into it again. Purchases and sales returns, right? We went into concepts of each one of these individuals, but right now we're just focusing on the revision of it. So all these have something in common. You know what's common in all of them? When they go up, they are debit.
Debit.
Wa alaikum salam. How are you, Musab? Good. So we're just starting out, Musab. We'll do the basics first, and then we will talk about the horizontal format of income statement. And then if we have time for the half of the class, we'll do chapter 9. Okay. So we have these 6 main types of accounts. It's assets, which has a lot of them. Like there are a lot of assets. Expenses, there are different types. Drawings, it's just drawings account. Purchases, just purchase account. All of them have something in common, which is when they go up, they're debited. When they go down, they are credited. And we went into why that happens, right? Just for the sake of revision, we will now just basically summarize it, right? So that's their nature. I'll give you an example if you want. So if we talk about an asset account, let's say trade receivables, right? Trade receivables. You made sales $500 on credit. Sales $500 on credit. 2 accounts are affected. Your sales account and your trade receivables. In this list, do we have sales account? Because sales are going up. Do we have sales account?
No, sir.
No. We will have it in the other list. From this list, we do have a trade receivable, which is an asset, and that's going up. And so we're going to write it over here, $500. Why is that increasing? Why is our receivable increasing? What did we do? Sales, right? The same way drawings work. If we talk about drawings or purchases, let's say for that matter, purchases. When you buy goods, your of course purchases are going up. Your goods for resale, purchases means goods for resale are going up, and you paid, let's say, cash for it. Do we see in this list? Do we see purchases? Yes, we do.
Yes, sir.
And when purchases are going up, where do we write them?
Debit.
On debit. We paid cash for it, so we write down that in the detail. In cash account, which is an asset account, when you see your cash account, if you notice when you purchase goods, your cash is going down. And when assets go down, they are what? Credited. So now if you go,
Credit.
you head to your cash account, you will see a credit entry. You get it? Sounds good? Hello?
Yes, sir. I got it.
All right. Okay, now we talk about this other set of accounts. Liabilities, income. Of course, these are just categories, and we have like plenty of accounts under them.
Capital.
Capital. Yeah, capital. Sales
Purchases returns.
and purchases returns. All of them have something in common. When
When
they
they
go,
went down, debited.
that's right. When they go
When they
down,
go up, credited.
that's right. We'll take a look at an example. For example, in this case, let's say, in this first situation, situation number 1, what happened was we sold some goods. So 2 accounts are on credit, 2 accounts are affected. One is sales, the other is trade receivables. In your syllabus, trade receivables won't be directly debited. It will be some customer's account, customer A or B or C, it will be debited. So trade receivable, customer A, B, C, whatever, under your sales ledger, right? These individual accounts appear under sales ledger. Let's not get distracted. So in this first situation, what happened was you made a sale and 2 accounts are affected, sales account and trade receivables. Both are going up.
Trade receivable.
Your sales went up, your receivables went up. When your receivables went up, since they're an asset, you debited them. When your sales go up, according to the rules, these
We
rules have
credited them.
explanations, by the way. You don't have to simply just memorize. We have understood why these are debited and credited. Right now, as I said, summary, right? Or let's say rule of thumb, like just finding shortcuts to some extent to how to approach these in your exams, right? The method of thinking here. So sales is going up, and the sales, when they go up, it's credited. You can also think of it as a revenue. Sales is a revenue or income, right? Essentially. And so it is credited by, let's say, in this case, 500, right? What are we going to write in details? If it's the name of customer, we'll write name of customer. In this case, we don't have individual customers. We just have a full combined trade receivables account, and so we're going to say trade receivables. Does that make sense?
Yes, sir.
That's the idea. Here you made purchases. Well, to represent the fact that cash is going down, we'll have to just use that left side because in that represents how when assets go down, they are credited. Well, this is an idea, right? We'll take another example from here. What if we have purchase returns? What if we have some purchase returns? So you return some purchases and you got a cash refund. Means you got money back into your cash book, right? And what's happening here? Your purchase returns are going up by, let's say, $100. By $100, you return your goods. $100. That's your purchase returns. And you're going to write down cash because you got a refund, let's say. Why is that? Because of purchase returns. That goes in the purchase returns account. Cash is debited. Purchase returns account credited. Cash is an asset. When you return your purchases, you're going to receive your cash, which is an asset. It goes up. It will be. It goes up. It will be. When cash goes up, it will be what? Anyone? Debited, right? Nobody's speaking. What happened? Am I even connected? Hello?
Sir.
Yeah.
Sir, actually, I was having some background noise.
All right. I don't know why others are not speaking. But anyway, so now we come to the point. What are we going to do at the end of the year? Well, trade receivables will go up and down. Trade receivables go up, down, up, down, up, down. Because trade receivables exist. When they pay, they go down. Like, for example, when your customer comes to you now and they pay you, right? They pay you in cash. What's going to happen? Your receivables now will go down. You don't receive that amount anymore. It's not a receivable anymore. So let's say your customers come to you and they pay you your $300 out of the 500. And so your cash account will be debited in the cash account, and your trade receivables, as you see here, will be credited. Why? Trade receivables is an asset. When assets go down, they're credited. Cash also is an asset when it goes up because they're paying you. The cash account will be debited if you look at it on the other end. Does that make sense to everybody?
For me, yes, sir. I got it.
What about others? Musa, Fatima?
Yes, sir.
All right. And Musa?
Yes, sir. Yes, sir.
Good. Hasnain, let me know in the chat if everything is making sense. Because Hasnain, you're new, and part of the reason I'm doing this is to revise the topics with you. And by the way, this is not it. The concepts are deeper than that. You need to go back to chapter 1, 2, 3 and revise them. All right. Okay. Now, trade receivables, if you notice, guys, we're going deep into concepts, so you need to focus, right? Trade receivables, they go up and down, right? Because they pay you and then they take more credit. The customers are they pay you and then they take more credit from you, means you sell them more. Now you have trade receivables. Then they pay you, you give them discounts, receivables going down. Then they again purchase from you, receivables going up. Receivables go up and down. You know what? Same goes for all your other assets. Cash, it comes in, goes out, comes in, goes out, comes in, goes out. Right? Even liabilities, they come in, they go out. They manage their own thing. But if you talk about purchases, you're purchasing goods. Whenever you purchase goods, listen to me carefully, guys. We're going deep into the concepts. Listen very carefully. You make purchases, your purchases account is debited. A week later, you purchase more, your purchases account is debited. When does purchases go down? They don't go down. Well, you can return, but then we have a return account separately. We never credit purchase account. It just keeps debiting, right? Does that make sense?
Right.
But until when? Is it going to go forever? Where do we stop? We stop where we transfer the amount to the income statement. That's where we stop. Are you getting the point? So throughout the year, you will make purchases. I'll go down a bit. Throughout the year, you'll make purchases, right? And at the end of the year, after purchasing like 400 debit, 500 debit, 200 debit, 800 debit, you're just making your purchases. At the end of the year, you need to close this account and transfer it to where? Anyone?
Income statement.
That's right, sir. You transfer these to income statement. So you will basically cancel this amount. You'll credit your purchase by 400. It's not like purchases are going down. Purchase account is being cleared. Okay, let me take you back up to the concept. When purchases go down, they're credited. Over here, what's happening is purchases account, yes, it is going down. It is going down and it's being transferred. We pick it up from here and we transfer to the income statement. Pick it up from here, transfer to the income statement. So we credited purchase account by 400. Why did we credit? Because we are transferring to the income statement. All right. Please ignore the handwriting because I'm still not so good with the pen. So anyway, income statement, it'll be transferred to assets. So if you notice, the purpose of this is to show you how things are transferred. We will get into the income statement perspective also, but right now let's just see how it happens in the T accounts. For example, the sales, they will also be transferred, right? Because they're going to be credited. When you purchase goods, purchases are debited. At the end of the year, the purchases are transferred to the income statement. When you sell goods, sales is credited. Every time you sell something, your sales will be credited. Because whenever sales increase, the rules here, whenever sales go up, the sales account is credited. And so sales account is going to be credited the whole year. And if you don't stop, it's just going to go on crediting, right? It will keep crediting forever. Unless At the end of the year, you transfer it to the income statement. Are you getting the point, all of you?
Yes, sir.
This 500 will be
Yes, sir.
good. Your sales account will go down because we're removing it. Throughout the year, we are crediting because we are increasing the sales. Now we're removing all the sales, transferring them to the income statement. So income statement, transfer. Please just understand that's income statement. This board is slippery. I told you a few seconds ago. What about purchase returns? Well, they will also be transferred. Whatever we have, we transfer it. We remove it from here. We put it into income statement. Statement. This yeah, go ahead.
Maybe you can say like all the accounts will transfer to the income statement.
No. Okay, that's a good point you raised because that's not true.
All right. I want to be clear.
That's the whole point I'm trying to make. Trade receivables, do they appear in your income statement? Trade receivables. Do you remember, Saleh? Income statement format. You never see trade receivables in it because they don't appear.
Yes.
In the income statement, only the things relating to a certain year are recorded. Relating to a certain year, which happened during a given period of time. So how much sales you made in the last week? Gap, like there's a whole time period for which an income statement is prepared. In the last 3 months, what were your sales? What were your purchases? What were your returns? Right? So your revenues and your expenditure, that's what's being compared. Your assets, your liabilities, and your capital, where do they go?
Income statement.
You want to think again? Your assets, liabilities, and capital, where do they go?
Statement of financial position.
Exactly. Exactly. SOFP, Statement of Financial Position, also known as balance sheet. The word balance sheet is not really used in your book anymore. SOFP, Statement of Financial Position. Assets, liabilities, capital go into SOFP. Expenses, income, revenues, purchases, sales, returns. What else? That's most of the headings actually. That covers everything that goes into
the income statement.
Right. Any drawing of goods, not drawing of cash or anything, because that affects your asset. But if drawings are taken for goods, they affect what? They affect your purchases. Purchases is just the goods available for resale. When the owner takes it away, you have now less goods available for resale. And so your purchases are reduced by that. Sounds good?
Yes, sir.
Now I take you to the vertical, no, not the vertical, the horizontal income statement. All right, take you to the horizontal income statement. In your exam, you're supposed to know the vertical one, but you have to know you need to know the concept of horizontal one as well. This is your income statement, let's say. I gave you like a one-liner yesterday, and I'm glad Fatma remembers it. I hope others also remember this. Not yesterday, I mean the previous class. Your costs and expenses are what? Debited in the income statement. And your income / revenues
are,
by revenues I mean sales, are
credited. Yeah.
That's the concept, all right? So purchases, let's say, is what?
Debited.
Yeah, as a cost, under cost of sales, of course. Under cost of sales, your purchases will be debited. Why? Because it's the cost. Any cost or expenses will be debited. So that's 400. Now this is where things are coming together. You see, we credited the purchase account and we debited the income statement.
Yes, sir.
Right? This way, our purchase account is closed. Our income statement got its value. Everything is adding up. Everything is making sense, I hope. Because everything has to come to an end. We make these T accounts. Where do we take them? Where do we take them with us? Well, we transfer them to the income statement. The assets, liabilities, capital account, we just keep balancing them. The revenues and cost and expenses and income, these accounts, at the end of the year, they'll be transferred to the income statement. Right? Here, I'm assuming that the business makes income statement every year. It can be at the end of 6 months, but in our syllabus, we focus on at the end of the year. Okay. What about purchase returns? Which category does that go into? Who's going to tell me? Purchases is cost, obviously. Purchase returns, is that cost or is that income? You know what?
I left my answer in chat.
Yeah. So Saleh says purchase returns is going to end up on the credit side of the income statement. So we put purchase returns. Conceptually, that is fine. Purchase returns as a concept, good, no problems. But just asking you, purchase returns, they are not a cost, they're not income, but they are reducing the cost. Now, if costs are debited and something reduces your cost, because when you return purchases, that's not a cost anymore, that reduces your purchases figure. And so it is essentially opposite of cost. And so we can technically we put it on the credit side. However, when we are making the actual income statement in horizontal format, instead of crediting it where it should go, rather than crediting, we actually subtract it. We subtract it from the, it has the same overall effect, right?
Rest.
But technically, the credit, it's a credit entry. Purchase returns account is debited. We're transferring on the credit side of the income statement. However, we don't write it on the credit side for, we can say for organization purposes, we put it with under cost of sales. You get it? That's the way T accounts work. Either you can put a credit entry to reduce it by 100, or you can subtract it from the debit side. Over here, overall, the answer is 300, right? Even if you put a credit entry, the answer is going to be 300. The balancing figure will be 300. Are you getting the point?
Yes, sir. Mean, sir, the sales and sales returns will be in the debit side.
Let's have a look. The debit side, you're getting a bit confused, but I think you know what you're.
I mentioned in the cost and expenses.
What? Sales? Or you mean sales returns?
The sales returns.
You're right. Technically, that's where it goes. However,
yeah,
I mean, according to rules, it goes on the debit credit rules, revolving entry rules. But for organization and to make more sense, we actually subtract it from the other side. Let's see. Sales account, as you see, it is transferred on the credit side of the income statement, as you can see from there. Transfer the income statement. What do we label that as? Sales, right? Because it's an income, automatically is credited. Automatically, this account is closed. See how things are adding up. Fatima, Musaf, do you see what I'm seeing here? The perspective here.
Yes.
Fatima, you good? And Hasnain, please let me know. Good. If you have any sales returns, if you go back to the rule board, I'm going to call it. If you go back to that, if you notice, whenever your sales returns, you're making sales returns throughout the year, debited throughout the year. When you're transferring the income statement, your sales returns credit, income statement debit, right? Income statement what? Income statement debit. Sales returns. However, instead of putting it on the debit, because it does not make a lot of organizational sense, instead of debiting it, we actually subtract it from the credit. Do you need to know like this exact method? No. You need to know the double entries though. You need to know that cost and expenses go on the debit, income and revenues goes on the credit. But when you read the book, you will see that purchase returns, which is opposite of cost, is also debited. You might wonder, why are we debiting something that's not a cost? Purchase returns is not a cost. It's reducing the cost. But you're subtracting it from here, right? Like it's supposed to go on the credit, but we're subtracting it from the debit, which has the same effect. I hope that all makes sense to you. Am I missing something? I think we've covered pretty much everything. I'll remind you once again, balance sheet uses the accounting equation we learned in the first chapter, first or second. Assets equal capital plus liabilities. That's your accounting equation. Assets equal capital plus liabilities. This is why your statement of financial position, also known as balance sheet, balances. Because balance sheet shows you assets equal capital plus liabilities. We have an assets section and we have a capital plus liabilities section. This is the reason why balance sheet balances. Does it make sense to all of you?
Yes, sir.
Some of you don't understand that.
Sir,
Uh-huh.
actually now I realized why I choose the vertical than horizontal.
That's
Because
right.
it is a
Yeah.
bit uh, difficult. Not a bit, not difficult.
Okay.
Like it is some
Of
complicated.
course. Of course. But and then look, I mean, we got quite deep into the concept, but otherwise it's not that hard. You're gonna list all your just like vertical section, just like vertical section,
Yes.
you're gonna put sales minus sales returns here. You're gonna put cost of sales here. And of course, if cost is smaller, you will get a gross profit over here. Gross profit, whatever that is. Well, let's say our sales are 600. In that case, if we keep it as simple as this, 600 minus 500, our gross profit is 100 because that side is smaller. We just balance that. Are you getting the point? If we keep it as simple as that, 600, 600.
Yes.
If we don't go further. Oh, wait. Why did I put it like that? Sorry. Goes under it, right? 600, 600. Now, you know what's going to happen next? This is your trading section. This 100 will go down to the profit and loss section, gross profit. And again, your expenses will be listed here. Your income will be listed here, right? Like rent, let's say, rent, commission paid, discount allowed, right? Discount allowed. Whatever expenses you have will appear here. Income will appear here. And your profit for the year will end up on this side, maybe 50, let's say that's the profit you made. And this will be transferred to, anybody knows? The profit for the year. Profit for the year. Where does that go?
Income statement.
Profit for the year. We have the income statement in front of us. We transfer the profit for the year to which account? Anybody know? Certain amounts will go there. Certain amounts will go there for income. Overall, we made a profit for the year of $50. We transferred that to the capital account. The capital account will be credited by 50, but we'll not be getting into that for now. The goal was to understand the horizontal format of income statement, not because you want to solve it this way, but because you will need to understand these transfers. How is income statement debited and credited, right? Because we are going to use the vertical format. In the vertical format, there are just calculations, no debits, credits. So this was a necessary thing to understand, right? In just a minute, I'm going to also explain you how expenses are debited in the income statement. Just a very quick random explanation. So we say we have rent account, rent payable, right? It's an expense. And throughout the year, you keep debiting it. $50, $100. That's the rent you're paying. Is it going to go forever? It's an expense. No. At the end of the year, you'll take the full amount and put it into income statement, right? Throughout the year, you paid for it, bank, because when expenses go up, they're debited. At the end of the year, transfer it to the income statement. 150 will be debited in the income statement as given here. Does it all make sense to you? We'll need to stop the recording for now.